BlackRock's fundamental fixed incomes head of global rates is with us on InsideTrack, Eric Pellicciaro. Eric, good to see you.
Thanks, Sarah.
So tell us, what's the big news that really matters out of Bernanke that nobody's talking about?
Well, we got a reasonable amount of information yesterday, but I think the most important piece of information was the shift in the committee's timing of the first move. And with only 4 more members now after 2014.
Wait, I'm just going to stop you because we do have a great graphic to represent this.
Great.
So you're saying, so this is the Fed's mission to be more transparent, to tell us who's voting. It doesn't name names, but how many Fed members are actually voting to increase rates. And there was a change. Explain.
So there was a change here. So the move that originally there were 6 members that were expected to tighten after 2014, and that's been moved down to only 4. That put the bulk of them into 2014, and you see that there's now 7 in 2014. With only 4 members after 2014, it suggests that possibly one of the 3 core doves has moved into 2014 from 2015, or perhaps never was in 2015. So there's some important information here because it tells us that maybe we're getting a little bit more hawkish, and maybe the doves are losing a little bit of that control. The statement came out probably more hawkish than I would have expected. There was room to be more dovish. The data has deteriorated. It's deteriorated against expectations. The equity market has deteriorated some. There was little reference to that. So it feels to me a little more hawkish than it would have been.
It's a big deal, and I want to ask you a little bit more about that. We're going to
the implications of this are the market has priced in a certain probability of the Fed continuing to ease, the Fed continuing to support credit markets and stock markets. The truth is, the Fed is probably further away than the market thinks. The backdrop for inflation, for growth, has really set the committee a little more balanced on where it wants to be, and is increasing the risks that the center doves like Bernanke, Yellen, and Dudley are going to have a harder time pushing more quantitative easing through. So I think you're going to need to see more pain in the equity markets before the Fed really comes back in.
Pain in equities.
We're going to see more pain in equities probably before the Fed comes in. You're going to have to see growth slow down more than we've seen, because it wasn't even referenced in any of the statements, the slowdown. So you'll see more than that. So the protection from the Fed isn't necessarily there. Also, what's happening in Europe, it's a big deal. It's kind of coming back. Sentiment is shifting again, and it's not clear what the easy solution is there. So investors should be looking at that. They should be focused on a Fed that's further away from easing than they originally thought, and therefore you should see an increase in volatility.
You're bearish on bonds as well?
Bonds, less so. What I would say is bonds will be supported if equities are hurt. And if you can put bonds in your portfolio, there'll still be good diversification. I would say that to investors. They're going to continue to work, and they're going to offer you that kind of protection that you need.
And the U.S. dollar, you say, is going up as we see
the
this
implications
change on the Fed.
Absolutely. I mean, the growth rate over the last 2 quarters, the demand from consumers has come back. The economy is in reasonable shape relative to others, and at the same time, we have a central bank that's moving from a little more easy to more balanced. So that should be good for the dollar as well.
All right, Eric Pellicciaro, he's bullish on bonds and the dollar, not on stocks, says pay attention. The Fed is changing its tune. Eric Pellicciaro is the head of fixed income global rates for BlackRock.